When it comes to investing on the stock market, the big end of town gets all the attention. Smaller companies also need capital though, and with the market still suffering post-global financial crisis blues, attracting that capital can be a very tall order. At a conference in Sydney today, a group of what's known as microcap companies has paraded their virtues to another group of would-be investors. Late Line Business's Andrew Robertson was there.
All investors know about the ASX Top 200. It's where most of their money goes. At the other end of the market, though, there are also good investing opportunities. The risks can be high, but the returns can be equally high. For example, wireless network provider Big Air has seen its share price jump nearly 50% in the last year after a 50% jump in earnings. It has no debt and a return on equity of 21%.
Certainly around reporting time, you get a bit lost in the big announcements from the big ASX 200 when they make their reporting announcements. Little companies like us generally get lost in the background.
Which is why chief executives from a group of what's known as microcap companies have taken the opportunity to address potential investors directly away from the shadow of the big end of town.
We do have some difficulties in getting our message across. We're a microcap insurance company, and therefore we're more difficult to understand than a retail or a manufacturing business.
However, despite the opportunity to sell the benefits of his company, Nick Kirk is not overly hopeful that more investment will be forthcoming.
With relatively high sort of deposit rates at banks and perhaps a slight risk aversion still being in the air following the GFC, I think for most small caps it's a tougher environment than normal actually.
At the end of May, there were 2,244 companies listed on the Australian Securities Exchange. Two-thirds of those companies had a market value of $150 million or less, which is what the ASX describes as microcap. Many of those microcaps have shares which are rarely traded and therefore a share price which hardly moves. For companies wanting to make acquisitions, it can be a big issue.
The stock price is certainly something that we're concerned about, and if we are planning to use scrip as part of the consideration, we'd like to see what we believe is the value in the stock more reflected in its price at the moment.
The alternative is debt funding, but unlike the big boys who can access wholesale capital markets, micro-caps have to go cap in hand to their bank, and that can be a problem in the post-GFC world.
It's tough still at the bottom end to get access to debt in terms of scale, and you need bricks and mortar typically as an asset base to actually get access to decent debt. If you're a technology company, a lot of banks don't put a lot of value to your PP&E or to your property, plant and equipment.
This conference is a snapshot of how the resources sector is becoming an increasingly important part of the Australian economy. 4 of the 9 companies presenting at the conference provide products and services for the mining industry. Runge is one of them, providing engineering support services in both Australia and overseas. But it's a double-edged sword. On one hand, business is booming. On the other hand, bigger companies keep poaching its staff to solve their skill shortages.
Our turnover used to be 12%, our attrition rate for our business. It's now much higher, up around the industry average of 20%. That means you've got to do a lot more recruiting, a lot more training. You've got learning curves for people. You have to introduce them and educate them about the technology and our core business proposition. It does certainly have a negative impact.
And is becoming a barrier to Runge's plans to take full advantage of the mining boom.